Somewhere between signing your name on a mortgage and unpacking your first box, the government quietly slides you a bill you didn't exactly agree to. Welcome to property taxes, the gift that keeps on taking. Here's the wild part. You don't just pay it once and move on with your life like a normal purchase. Every single year, like clockwork, your local government looks at your home and essentially asks, how much is this thing worth now? And then they send you the math. Think of your property's assessed value like a report card for your house, except instead of grades, it's a dollar amount your local assessor decides. They're basically the judges of a beauty pageant your house didn't sign up for. Once they've got that number, they multiply it by something called the mill rate, or the local tax rate, which is just a fancy way of saying the percentage we've decided to charge you. In some places that number is low and friendly, and in others it'll make you spit out your coffee. Here's the honest truth about where all that money actually goes. A huge chunk of it funds public schools. That's why two houses that look almost identical can have wildly different tax bills just because one is in a better funded school district. Roads, fire departments, libraries, parks, all of that is basically running on your property tax tab. You're not just paying for your house, you're literally co-sponsoring your entire neighborhood like a reluctant Kickstarter backer. Now here's where it gets interesting for anyone who owns investment properties, or is thinking about buying one. A lot of new investors fall into the trap of calculating cash flow without ever factoring in the annual tax bill, which is a little like budgeting for a road trip and forgetting gas exists. Let's say you buy a rental property for $300,000 in a county with a 1.2% tax rate. That's $3,600 a year just in taxes before you fixed a single leaky faucet. If your tenant's rent isn't covering that plus everything else, you're not really making money, you're just slowly donating it. The location factor is real, and it is ruthless. Two identical properties in different cities or counties can have tax bills that are thousands of dollars apart. Texas has no state income tax but property taxes that could make a grown adult cry, while Hawaii has low rates but homes so expensive it almost balances out anyway. One thing people don't expect is that your tax bill can go up even if you didn't do anything. If your neighborhood suddenly becomes desirable, maybe a trendy coffee shop moved in, or the school ratings improved, your assessed value can climb and your taxes go right along with it. Some places try to protect long-term homeowners from that roller coaster by capping how much assessed value can increase each year. California's Proposition 13 from 1978 is the most famous example, letting some homeowners pay taxes based on values from decades ago, while their neighbors pay full market rate. You can actually appeal your property tax assessment if you think they got the number wrong, and a surprising number of people win those appeals. It's basically your one chance to argue with the government using comparable sales data. And honestly, that's kind of empowering. The smartest investors treat property taxes like a utility bill, predictable, unavoidable, and always worth researching before you buy. If you skip that step, you're not doing due diligence, you're doing wishful thinking with a down payment. Property taxes are never glamorous and rarely make anyone's highlight reel, but understanding them separates the people who build real wealth from the ones who wonder where all their money went. They're the boring foundation under every smart real estate decision. At the end of the day, property taxes are just one piece of the puzzle, but they're a piece that can completely change the picture if you ignore them. If you want to go deeper on how to factor taxes and other costs into smart investing, are you curious about what our company can do for you? Check out the links in the description.